Your salary didn't change this week, but your money just became weaker. The rupee is hovering near 91 against the US dollar. But what does that mean for you? Is this just a number on a screen, or is it quietly changing your financial future? This is not just a currency story, this is a purchasing power story. And by the end of this video, you will understand why the rupee is weakening, how it affects inflation and petrol prices, which sectors benefit, which sectors suffer, and what really matters next. When USD is at 91 rupees, it means India needs 91 rupees to buy 1 US dollar. If last year it needed fewer rupees, that means the rupee has weakened. And when your currency weakens, imports become more expensive. India imports crude oil, electronic components, machinery, semiconductor inputs, defense equipment, all priced largely in dollars. So, when the rupee weakens, India pays more in rupee terms. But here is where it becomes personal. India imports crude oil, oil affects the fuel price, fuels affect transportation, transportation affects the food price, food prices affect the inflation. So, inflation affects your purchasing power. So, even if your salary stays the same, what your salary can buy reduces. That is how currency weakness becomes silent inflation pressure. But does a weaker rupee mean economic disaster? Not necessarily. A weaker rupee can actually benefit the exporters. Let's say an IT company earns revenue in dollars. If the dollar strengthens, their dollar earnings convert into more rupees. So, companies like IT exporters, pharma exporters, specialty chemical exporters can see margin support. That is why sometimes markets don't panic when the rupee weakens, because sectoral impact matters. But then why is the rupee weakening now? Several forces can drive the currency movement. Dollar strength globally, higher US interest rate, global risk aversion, oil price volatility, capital outflows. When global investors feel uncertain, they move towards the US dollar. The dollar becomes a safe haven. Emerging market currencies like the rupee face pressure. But here is what investors should really watch. One level, like 91, doesn't define the story. The trend does. If the rupee weakens gradually, markets adjust. If the rupee weakens rapidly, confidence shakes. And then RBI intervention, bond yields, and equity flows come into play. Currency stability affects foreign investor sentiment, inflation expectation, corporate cost structure. It's interconnected. A weaker rupee does not automatically mean crisis. It means pressure, pressure on imports, pressure on inflation, pressure on policymakers. For investors, the key question is this temporary volatility or the start of a structural currency shift? Because currencies move slowly, but when trends build, they reshape economies. Your salary might not change, but what it buys always depends on the currency strength. That's the part most people ignore.